So hello everyone, my name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. So firstly, I would like to thank all the participants for taking their time out and joining in today. It's a very special day because I am joined on this call by Mr. Hiren Ved and Mr. Deven from Alchemy Capital Management. So it's a again, as I said, it's a very special day because it took me some time to kind of seek an appointment from Mr. Hiren and finally get him on the show. So thank you so much, Mr. Hiren, for accepting our request.
No, thanks. It's a privilege to be here amongst you and all your subscribers. And I hope that they will all take away something important after today's session. The way we have decided to structure today's session is that I will start by giving an introduction on alchemy and what was the basic philosophy behind the product. What was the need for Alchemy Ascent, which is a rule-based, portfolio management technique. And then I will let Deven talk about the exact mechanics of how the product works,
Sure.
share some experience and data of many years of back testing and almost 2.5 years of live performance of the strategy. And then we can move on to Q&A.
All right. So let me have the privilege of introducing you. So Mr. Hiren Ved brings about almost 2 decades of experience on the table. In fact, sorry, it's 3 decades, almost 29 years as we speak. So he is the co-founder, director, CEO, and CIO at Alchemy Capital Management. He started his career in 1991 and worked on both the sides, sell side and buy side research role. For the first time in his career, before joining Alchemy, he was kind of spearheading the firm asset management business in the year of 2000. So Hiren has deep knowledge across sector and known for his bottom-up research, stock picking, skill set, and he's also built a long track record. So the first time when they started their PMS, this was 2002. So they bring about almost 19 years of very long track record. If I have to quantify in terms of number, then I would say somebody would have put 1 crore rupees. That would have now grown to almost 42 crores rupees over a period of these 19 long years. So that clearly indicates that it has a very long and a consistent track record. So today we thought of inviting him and we'll have a detailed discussion about what is called rule-based investing. And also, I have few questions that I'll be asking on behalf of all the investors, and then we'll open the forum for Q&A as indicated by Hiren. So over to you, Hiren.
So thanks Vikas again, and welcome to all the participants. So as you know, Alchemy is one of the oldest portfolio management firms in India. We've in May this year we will complete 20 years of track record of managing money, at Alchemy we are completely focused on just one asset class, which is equities. So unlike many of our peers who have diversified into doing many other things, wealth management or other asset classes, distribution, etc., we've stayed away from defocusing from what we believe we are good at, which is managing equity portfolios. And this journey of almost 29-30 years has taught us a lot, and the markets continue to teach us even as we speak. And really, a couple of years back, me and one of my other founders, as we were discussing and reflecting on our journey thus far, we realized that essentially there will come a time where we need to disrupt ourselves, right? And as all of you know, that every industry is getting disrupted today because of technology, because of regulation, because of availability of new tools, computing power, and therefore, if we don't disrupt ourselves, somebody else will come and disrupt us. So the basic idea was, if I were to use a very simple analogy, right? So if you have a great restaurant where you like the food, you go anytime to that restaurant because it's a great restaurant, you like the food, you enjoy the place, you enjoy the ambience, you enjoy the service, and essentially the food every time you go tastes good, and that's why you keep going there, right? And usually behind that there is a great chef or a group of chefs which are preparing that food, right? And more often than not, that's why you have a Michelin star restaurant where you have a great chef. He's a very skilled person, and every time you go to a restaurant, he dishes out the same great dish to you, right? Similarly, in investing, right, when we say that we've been around for 25, 30 years, there is a lot of understanding of history, of market cycles, and over a period of time, obviously, when you keep doing something consistently, you become good at it, right? And therefore, the idea for us was that when I say rule-based investing, that doesn't mean that other people don't use rules, right? Many of them kind of write down the rules, they follow certain pattern. Sometimes the rules are in the head by way of experience. There are certain patterns that form, which tells you that when you look at a company, when you understand a company, when you look at the data, you look at the financial numbers, you look at the ratios, you talk to the management, and then there is a certain a set of rules which are there, which your mind has been trained to. As you look at hundreds and hundreds of companies, people all have rules, and active managers who actually build portfolios, fund managers, investors, they all have set rules in their mind, right? And the way I look at the wealth creation process through portfolio management, if I break it down into three broad categories, one is that stock selection, right? What kind of companies do you want to invest in? What kind of businesses you want to invest in, right? And what I've found is that most portfolio managers spend disproportionate amount of time on this first aspect, which is stock selection. But equally important or more important is portfolio construction. So it's not just about selecting a great company. It's about how you construct your portfolio, right? How you size your position. How much do you let your profits run, right? How do you think about opportunity costs, right? So once, let us say, I'm just giving a hypothetical example. Let's say you're building a 2025 stock portfolio. Once you build the portfolio, what happens when you find the 26th great company or another great company? What do you do, right? So which I put under portfolio construction. And third is, how do you manage risk, right? When you sell a company, what happens when something goes wrong, and therefore risk management is the third important pillar. And it is the combination of stock selection, portfolio construction, and risk management. All three have to sync together to deliver superior risk adjusted returns, right? So it's not one aspect that is important. And therefore, our belief is that when we decided that we want to fuse all these three, right, you need to have very clear rules of how you are going to carry out each of these three broad activities to build a portfolio, right? And what happens is that, as I said, most of the people spend a lot of time on the first aspect, finding a great company, finding a great business to invest in. But that's not enough, right? And the reason is that, while an experienced person can keep doing it, right? So let's imagine if tomorrow you have a great restaurant and you have this great chef, and the chef decides to leave. What do? Right? So the idea is that if you're a business owner, if you're a restaurant owner, you would want that the same customers and new customers keep coming in because of the word of mouth, because people say, hey, did you have food at this restaurant? It's great. Is how do you institutionalize a great recipe so that every time the customer comes, he gets the same consistent quality and great food, right? So what we did was that we used all our experience of the last 15, 20 years, the recipe of somebody doing it well. And we actually wrote down that recipe in a very objective form, in a form of set of rules, right? And we all can say, there are so many great managers. Every manager during his lifetime has had great hits, right? So somebody will say, for example, Alchemy will take credit for saying that, we were one of the early ones to invest in Bajaj Finance. Look at the kind of value we've created. Somebody will say, I bought Asian Paints and look at the value I've created. Somebody else will say, I bought Bharti very early. Look at the kind of value I have created. And all managers have their successes. They've all found some companies which have done phenomenally well for them. Our idea was that why should we look at only our successes? Why do we not look at somebody else also who did well and we did not pick that stock? And we asked ourselves the question, okay, you did very good in these stocks, but why did you not pick those stocks which somebody else did well in, right? And therefore, when we sat down on a whiteboard, we realized that all great companies have certain attributes, right? They have a certain quality. Now, many times you would have seen managers say, oh, we buy good companies, we buy consistent cash flow companies, we buy companies with great return on capital, we buy companies with so and so attributes. And we said that ultimately finding winners, and all winners display a certain set of attributes. And it's the combination of these attributes, right, in a given context that makes these companies consistent winners. So what we did was that we looked at all the great companies which have delivered fantastic value to investors over a period of time. And we said, these are all the attributes, necessary ingredients that are required to prepare a great dish. Not only my dish, but anybody else who did very well in those companies, right? So basically what we try to do is assemble all possible attributes that are required for a great company. Secondly, this selection is based on very objective data. So there is no subjectivity, right? कि नहीं ये तो बहुत अच्छा है, ये तो बहुत अच्छा management है. In Ascent, we say, when you say acha management means, what is the meaning of acha management? How do you define acha management, right? And therefore you say, okay, great management is where there is growth, where return on capital is very good, working capital is great, cash flow is positive, capital allocation is right. That is how you can objectively define what is good management. Yes, there is always a subjectivity, but in this particular product, anything that you want desirable in a potential investment candidate needs to be very, very objective, right? But then the challenge comes is that, okay, there are 5,000 listed companies here, and there are so many sectors, right? And each sector has a different nuance to it. And therefore, even if you say, let's forget 5,000 companies, even if I have to choose between 250 to 300 companies, it's not an easy task, right? Because there is a lot of data today that is available, right? In the old days, when I started, there were only half-yearly results, and then you used to get balance sheet data at the end of the year when the balance sheet used to come, right? Today, you have quarterly results, you have earnings calls, then in between there are conferences, there is a lot more data that is available to you today than it was available historically. So it is virtually very difficult for a active manager to go through that number of that amount of data consistently, right? Now, one way is that people say, okay, I have a law, I have a big research team. So, ठीक है, आप कितना बड़ा 4, 5, 10 लोगों का research team रख लोगे? How big a research team you can keep, right? But what today you have data, you have a lot of structured data, and you have computing power, right? So once you set your rules, your parameters, today you have the ability to churn through thousands of data points and financial results of hundreds and thousands of companies, right? So today that is possible because you have computing power to be able to do that, right? So the advantage is that you can set your quality filters, you can set your fundamental filters, and also price is used as one of the input, because price is also one of fundamental factors, right? Old theory taught you that you look at fundamentals and then the output is you'd say, okay, this could be the expected price. But the market talks a certain language, stocks behave in a certain manner because the price behavior. And that's not the only reason, because here we are not trying to do momentum based investing or technical analysis that we are using only price. We are using a combination of fundamental factors and price to very objectively go through a universe of companies and find out candidates which have required or requisite attributes of a winner, right? Then when you come to portfolio construction, again, right, how do you rank when you have so many companies or candidates across so many sectors? That's another challenge you have, right? So this system is not only about picking great companies, but it is also about ranking companies. Think of it as a university, if I were to give an example. यूनिवर्सिटी में या एकदम कोई elite college है, उसमें इतने ही सीट हैं. Let's say there are only 100 seats. And how does a university accept students? They have a marks cutoff. And they say कि अगर आपको, if you got marks beyond this, so let's say my cutoff is 94%. So all students who are above 94% are eligible, right? So you want the best students, the best academically brilliant kids to be part of your university or college, right? So we do something very similar in the portfolio construction. We round up all these companies which we believe are great and rank them so that we are able to select at any point in time the best students that are available. How do you size your position, right? Whether you should buy 3% or 6% of a company in a portfolio, right? That is also something that we do in a very objective manner. And the whole production process is important, right? How you manage the portfolio once you've chosen the company and built the portfolio. How do you shuffle your portfolio, right? How do you think about opportunity cost? And that is something, again, what typically happens with active managers is एक बार ने model portfolio बना दिया, you create a portfolio. Then mostly people don't that often think about, there may be other sectors which start to do well. There may be other companies that start to do well. And how you think about you not participating in those companies because there may be a opportunity cost of something sitting in your portfolio not delivering return. There may be other candidates which are very good. And therefore, portfolio construction is as important as finding a great company. And last is, how do you manage risk, right? So when do you sell a stock and why should you sell a stock? And therefore, in this system, we've even created the ability, a very objective, non-biased way of buying and allowing a certain threshold. So we look at fundamentals and price both again. So if there is substantial deterioration in the fundamental of a business, then obviously it will start giving lower marks, and then therefore that student is out, and maybe another student which is scoring very well will be brought in, right? Because you always want to keep the name of your university, because your university is good because you always have the best students who get admission into the university. So I think what we have done is that without any biases, having the ability to sift through humongous amount of data in a very structured manner, and then trying to use all that we have learned in the last 15-20 years and to codify it into a very objective algorithm is what the attempt of Alchemy Ascent is. And as a result of that, we did almost 5 years of work to build the system. We almost tested the system for 20 plus years with a lot of data that we had historical. And our idea was that over a 3 to 5 year rolling basis, the strategy should have the ability to generate significant alpha over the relevant benchmark, right? And in this case, we use the BSE 200 as the benchmark. So it's not very narrow, neither is it too wide, because broadly speaking, we are working with the top 17.5% cutoff market cap of companies which are available, right? And therefore, the ability to construct the portfolio from the best candidates. And also what happens is that, you know, for let's say what's happening in the market today, right? So for example, suddenly there are sectors which investors had long forgotten to invest in: metals, textiles. I mean, these are sectors that do not come very naturally today to active investors, right? So we've all, because there are so many companies that did phenomenally well in certain sectors like consumer, staples or discretionary or financials, right? We naturally tend to gravitate towards those sectors. And suddenly we found, but the world is very dynamic, right? Fundamentals change, equations change, and suddenly you may find new sectors which might start to perform. And what the system has done, and you know, Deven will show that, is that we have the inherent flexibility that this system was able to capture a lot of these trends very early, right? So it invested in specialty chemical companies very early in the life cycle. They invested in textile companies very early in the life cycle. Now, I'm, as an active manager, though I've been managing active portfolios for 20 years, if I have to now start looking at textile companies, I have to go back many years, you know, when I used to look at textile companies early, relearn a lot of the things. And there is always a latency time before I would catch on to a trend. That's the advantage that the strategy has got, that the moment it starts to see that the numbers, suddenly why are the numbers improving? Why are the margins improving? Why are the cash flows improving? Why is the growth improving in a certain sector? It does not have any bias. कि नहीं मैं तो metals देखता ही नहीं हूँ, मैं तो textiles देखता ही नहीं हूँ, we don't do this, we don't do that. It is completely unconstrained, right? The only thing we have done is that we've cleaned up the universe for any governance issues, right? So we've cleaned up the universe and said we will not invest in certain kind of businesses. And there are very clear quality thresholds which we have put in place, which means that by and large, notorious companies and notorious businesses don't get into your portfolio, right? So basically, that's the advantage that we bring to the table, that years of learning, very objective way of analyzing, very structured way of building a portfolio, and a structured way to manage risk is what brings together all of this into the strategy. So what I'll do now is that I will hand over the next part to Deven. He will take you through the mechanics of the product, and then we'll be happy to answer any questions.
Yeah. All right. Over to you, Deven.
Yeah, thanks, Hiren. Thanks for that. So I just wanted to say that this recipe has been fine-tuned over 6 years. Back in 2013, when proof of concept was put in place, that yes, a rule-based system is something that we would like to see of how do you repeat the success, right? So, this strategy has taken time over 6 years with 2 years of our own prop money to refine and develop. And as Hiren put it, it's a recipe that we have taken some time to refine over a period of time. However, just to share the crux, right, there was a mandate which was given for this algorithmic strategy, right? I would just like to highlight those things because that is the core essence of our strategy. Right, some points which Hiren did cover, but I would like to categorically say these are the main essence of our core algorithmic strategy. One is this: every investment thought, right, must be stated objectively and quantifiably. Right. So investment thought cannot be subjective. It has to be mentioned in an objective manner and it has to be backed by data. Right. So for example, which Hiren mentioned, if the company is superior or when the active manager says the company is very good, we would want a quantifiable parameter in either in terms of return on capital or a return on asset to back that claim. Or for that matter, someone says that this company deals in a very niche product, then their operating margins have to be better, right? So that is one mandate. The other one was this strategy will not forecast, right? Forecast can go right or wrong, right? If everyone got the forecast right, each active managers would have sat on a lot of money, right? What we realized that the winners, when we back tested and when we checked, right, which Hiren was mentioning, that we looked at some of our winners, we looked at some of the other winners, right? Some of the attributes were always present in the numbers before they ran up. For example, Bajaj Finance, iShirt, right, or Asian Paints or Infosys for that matter. So, and also we have seen that the cost of conviction is very expensive. If you believe that, something is going to do well, and if it doesn't do well, then the cost that is there is quite significant. So we said that we will go by data rather than conviction to invest in this strategy, right? Then the other part of the core essence of the strategy is that we don't work with what markets can do, right? But what is our response to the markets, right? Now, market is influenced by many parameters, right? There is oil, there is Russia, Ukraine war, a lot of things that will impact the market. Now, it can be very fancy to say that my model is working on, so many data parameters and so various parameters, but then, we see that this is the model is not sustainable or stable. So we have limited ourselves to 50 quantifiable parameters and a cross web of 250 interactions between these 50 quantifiable parameters, right? And I will touch upon that we do not work on a model portfolio. We have a bespoke designer portfolio for each client, and that will be touching in the portfolio construction piece. The other thing which we have realized is that in this strategy, we said that we will not argue with the markets, right? Market price is the ultimate truth. Because in the past, what we have seen is that market, right, arguing with the market on the downside increases your risk, and arguing with the market on the upside limits your positive potential. So that was another mandate that was put through. The other thing which is most important is portfolio construction, right? You would
just 1 second here. I just wanted to elaborate here on one point when he said that we don't argue with the markets, right? Let me give you an example. I remember many years ago, actually this is around 2014 or 15, many great portfolios had Sun Pharma in them, right? It's a great company, delivered fantastic, consistent returns ever since it got listed for 10, 12, 15 years in a row, right? And what happens is that when something like that happens, a bias starts creeping in. Ye to bahut acha hai, right? And if you actually look at the chart of Sun Pharma, I think it peaked at about $1,200 odd in 2014 or 2015. I forget the exact year, right?
Yeah, around
And then,
8. Yeah.
yeah. And then for 5 years, it didn't give any returns. And the stock went, and every time from 1,200, it went to 1,000. People said, "Arey, bahut acha company hai, kharido." 1,000, it went to 900, people averaged. 900 went to 800, people averaged. It went all the way down to 450, right? So you don't argue with the markets beyond the point, right? And your biases creep in. And for 5 years, it didn't do anything. On the other hand, it gave negative alpha, right? So that is one example of not arguing with the market beyond the point. Similarly, when I come across a lot of investors, including myself, somebody or the other has not invested in HDFC Bank at some point in time. बोला यार वो तो हमेशा expensive था, you know, I could never buy it, or I bought it but I sold it very early. उसके बाद तो, you know, it went up, ran up 10x, right? So that is all our perception beyond the point which plays, right? What is expensive, what is cheap, what you should keep averaging. You don't beyond the point argue with the markets, because the markets, unless obviously you are dealing with very illiquid stocks which can go up and down randomly, but these are all very, there are so many investors who regret having not invested in Infosys during the best growth years of Infosys, because they could never catch it, right? They always found it expensive, right? So we realize that these biases creep in, these judgmental calls which are not very objective creep in, and there has to be some final arbiter. And we believe at the end of the day, the markets can be wrong in the short term, but in the long run, they are never wrong, right? So that's why we don't want to either limit our potential because of the price on the way up, nor do we want to keep arguing and bleeding when beyond the point the price keeps going down. Sorry, continue, Deven.
Right. So, so discipline is the other aspect. So we said, like we said, it is completely void of emotion. So this is the core essence on which the strategy was built, right? So it is very result oriented. It is unbiased. It is disciplined. It is consistent, and it is always backed by data, right? So with this, right, so Hiren mentioned their experience and their thought process has gone into creating it. We have taken over 4 years of reiterating, refining all of these things, right, to derive on a 50 quantifiable parameters, right? So we said that, we'll let us look at what is more important, and we said we zeroed in on 50 quantifiable parameters, but we always mentioned that the parameters will not act independent, right? We have created 250 interactions between these various parameters, right? And we have given it 4 subjects, continuing with the metaphor which Hiren had mentioned, right? An elite university. So these are the 4 subjects in which the stocks are ranked or evaluated on, which is growth, valuation, quality, risk management, and market cycle, right? So each of these parameters that we look through and we give marks. Now a positive attribute, right, if the net margin or ROC is superior, right, we give a positive marks to it, right? Coupled with a lower debt to equity ratio, again a positive mark. So there is a cobweb, right? There is 250 interactions. Each interaction, depending upon the previous one, we give a positive marks. One more important thing is rejection is most important here, right? What we do is we give negative marks for companies, and we've seen, this is from their our back results and analyzing things. We see that the revenues are going up, but cash conversion is only not happening, right? Then we start giving negative marks to negative attributes. Or if you have a significant debt on your portfolio, in your balance sheet, then we start giving negative marks. So what we have done is across these 4 subjects, right, we started giving marks to each and every stock. So now what happens is we look at top 17.5 percentile of the market, right? Right now it stands anywhere above 8,000 crores. So around 370 to 400 companies are ranked and analyzed every single day for those 50 quantifiable parameters and their 250 interactions on them. Basis that, right, we give and allocate marks to each of these companies, irrespective of which sector they belong to, irrespective of any of the anchors. So the only thing is the market capitalization. If it is beyond 8,000 crores and it is not part of our negative list, right, some miscurrents which we don't want to come into our portfolio, then we start ranking these stocks. Now the other important part is which again the mandate was that portfolio construction is more important than having that one single multi-bagger. So on an average, we hold 25 to 30 stocks. The system gives a weight anywhere between 3% to 6% for a particular stock. However, right, if you get an exceptional candidate, it's a brilliant guy who's scored good in all 4 subjects, we say we will be able to buy up to 10% at cost into that stock, right? So that is where we don't take concentrated bets. Our portfolio creations are, and a typical portfolio will have anywhere between 25 to 30 stocks, right? All our stocks which come through in the portfolio have passed through quality filters, and there is a strict risk mitigation platform which is put into place, right? So let's say in our portfolio, right, there are 2 ways in which the stock can move out after it has come into the portfolio. One is on its own merit, right, where some of the thresholds go down, the growth comes down, or your fundamental parameters come down, or your balance sheet starts showing negative marks, or it comes down significantly with respect to other people, and it has been sitting in the portfolio for a certain period of time and not performing, then the stock will move out and a superior candidate will start coming in, right? Also, the other way is if our quality thresholds, minimum thresholds have been breached, then the stock completely moves out without being replaced, and then the strategy will find the next best candidate to invest into. So this is how it is been doing this. It is structured, right? So now what we did was we had to backtest this, right? So in theory, everything is good, and we wrote all the rules down and we said, okay, this looks right, right? Now let's go ahead and test it. So what we did is we took a window period of 21 years, right, from 1997 to December 2018, and we tested this strategy for the rules that we had written, right? And after refining, this is the strategy which is live currently, even with live money. You would see that over this 21 years of backtested data, this strategy has given an annualized return of 33%, whereas the benchmark, which is BSE 200, has given a return of 13%, right? Here, I would like to highlight that this strategy is based on an investment chassis, right? It is not momentum based. It is not trading platform. It is a investment chassis, PMS platform to invest and create that additional wealth, right? So you would see that, on a monthly basis, there are a lot of numbers, sorry, on this graph, but I'll just highlight a couple of them. On a monthly basis, over this 21 years horizon, the strategy performed better in 63% of the time. And even on an yearly basis, it performed better on an 82% of the time. Now, like I said, this strategy is designed to be invested for over 3 to 5 years. Now, if you see, what we did was, if you draw a single line, you can say, boss, the base was small, you can always give a superior return. Anyone would have given that. right? So what we said is, let's cut this strategy into small pieces, right? Let's do a 3-year or a 5-year rolling and see how the strategy is performing. So if you see the data, when you give this strategy enough time, which it has proven in live money also and in backtested also, it has always beaten the benchmark and created that additional alpha over the benchmark, over 5 years rolling period or 3 years rolling period for that matter. Now, what happens is, all these investors would want to say, ki yaar, abhi to market top pe hai. If I invest now, what will happen? Or, is this the right time to invest? So what we said, that the strategy has to be robust enough to be able to do this on various cycles, right? So what we did was, we tested this over 31 different data points, right? On the start of the market, at the bottom of the market, near market top, right? And we have seen that this strategy creates significant alpha when you give it 3 to 5 years of time. So when you look at this, the near the market top in 2000, the strategy gave a 20% return in backtested data, whereas the benchmark gave 5% return. All right. So this same strategy has been live. Now, one of the other aspect which I wanted to share with you guys was the fact that this strategy does not shy away from creating cash, right? Because at every single day, it looks at where the market is and deploys money. However, if it feels that the market conditions or the stocks are, the fundamentals and things are deteriorating, it will go and sit in cash. So if you see in a backtested data, back in 2000 and 2008, it created up to 70 and 60% cash. Now you can say, this is the back tested data. Ye to tumne back test mein kuch run kiya hai. What is there in COVID scenario, right? COVID was a similarly sharp correction scenario. So even in COVID, right, our strategy was fully deployed in March, in December, but in March the strategy went and sat up to 65% in cash, right? And then slowly started deploying once the market started improving. So the other aspect of this, and the beauty of a system, is that it will look at the market situation and it does not shy away from creating cash. And this is what the strategy has proved in the backtest as well as in a real COVID scenario. All right. So these are the rolling returns over 5 years and 3 years in the backtested data, and it has created significant alpha. So now, before we move on to the live data and the numbers, I just wanted to say, this is the core essence. It is completely unbiased. It is void of greed, fear, and hope, right? There is no emotion involved. It is void of greed, fear, and hope, and it is completely disciplined. Right, our systems run it. There is no manual intervention to the strategy that we do, or manual interventions which are taken from the fund management side. It is completely disciplined. It is back tested for 21 years. Now we have been running this strategy for almost 3 years now, and it has proven, even, and everyone would say that last 3 years have been one of the most volatile part of the markets, with sharp corrections and sharp upswings, right? Even in such a scenario, our strategy has proved, right? The churn ratio of this strategy is around 67%. On an average, this strategy sits on 10% of cash, right? So this is the other point which Hiren was driving, that, if you see some of our stocks which are here, Deepak Nitrite, KPR Mills, KPIT, these are our strong, large holdings. And the return that this strategy with live money, right, has given over a year, it has given a 62% return, whereas the benchmark was 29.8%. So this is the kind of return that the strategy has produced over a period of time. And if you see the, this strategy is completely void of sector and cap allocations. It's a bottoms up approach where it finds opportunity. It will go ahead and, invest in that company as long as it meets the market cap, as long as it meets our quality parameters and fundamentals are in place, the stock will come into our portfolio. So Yeah, I would like. I thought that this would be, crunch it small, and let's hear it from you guys. If you guys have any questions, that format will work out much more better than me just talking about the product. So, guys, if you have any questions, happy to answer those.
Sure, sure. So you can turn off this
Sure.
presentation, and then we'll have the Q&A. So, all right. So we'll open the forum for question and answer. So, dear participants, if you have any questions, please type in your questions in Q&A box, not in the chat box. So I have a couple of questions, which I keep getting on behalf of our investors. I would like to ask this. When I was looking at the data points, I looked at one of the things is that your market cap is the minimum threshold is 4,000 crores, and your market cap is increasing day by day as we go ahead. So is this strategic, or you sort of align with the market eventually?
So this is actually very strategic. We always said that we wanted to look at the top 17.5 percentile, right? So when we started off, right, the market cap was 4,000. And now where we are, the cutoff for us was 4,000 crores, right? Now the market has also grown and the size has become around 8,000 crores. So it is very strategic. And I would like to highlight here is like we try to, work the way Nifty works. Nifty is very ruthless, right? If you see the constituents of Nifty back in December 2000, and if you look at the Nifty constituents now, only 18 to 20 have survived. But that 18 to 20's market cap has gone up significantly. The rest all have moved out. So this strategy also works on a similar basis. It culls out all the losers and sticks with the winners. So what we have done is we have said that we want to act only in the top 17.5 percentile of the market cap, so that is significant size, there is liquidity in those counters, and it's not easy to manipulate, right? Because it's system driven. So that is where we are, and it is a strategic play that we have played.
Sure. The other thing is we also heard Hiren talking about all the forensics research and everything is done. So a lot of filtration is done before you look at your universe of 350 to 400 stocks. There is a lot of emphasis which is made on meeting the management, which is a traditional way of investing. And now on the other side, you have rule-based investing. So can you throw some more lights on that?
Yeah.
Right.
So basically, I think that as active managers, we want to meet the management to get a sense. We want them to guide us in some manner. Ki future mein kya hoga? How do you see the growth panning out? Right now, all those things are not possible when you have a rule-based system. Actually, you don't want those biases to creep in, right? And therefore, we said that whatever you want you should be able to see it in the data, right? So it is quite possible there is an honest management and he tells you that, look, I'm going to grow at X, and he grows at X, right? Then there is no problem. So between our system, if he actually grows at X and you can see the numbers and you can see the trend, we don't have a problem. But let's say you have a management who says, I will grow at X, but only grows at X minus Y. Then you have a problem, right? So, there are always advantages and disadvantages. So this system is not here to predict ki kal kya hoga, right? It is not based on projections. It is not based on, oh, I felt very good after meeting the management. Right? For that, you have the active managers doing that, right? And as I said, there are several ways to make money. Today, people also invest in index funds, right? Usme whether you meet the management, don't meet the management doesn't really matter, right? So, yes, there are no extra insights that you will get by meeting the manager. Our thing is very clear. In fact, when we looked at many of the winners, we were very seldom we had a situation where everything was based on us thinking about the future or drawing a future hypothesis of a company. All great companies gave you enough chance to buy when the numbers were already there on paper and good. It is just that we have our biases, or sometimes we are unable to decipher it, or we don't have that kind of bandwidth to go through so many numbers, right? And therefore, we believe that it's not a handicap in the system if we don't meet the management, we don't talk to them. What this system does is it talks to numbers. If aapka number aaya and you have the right combination, you have the right attributes, then you are of use to us.
So in that case, because there is a saying that you cannot afford to time the market. So what's your deployment strategy like? Then in that case, does the system give you some sort of alarming situation that you cannot deploy everything in one go, or it is what's your strategy like, or it is deployed overnight?
Deven?
Yeah. So, the deployment strategy is basis where the market is and what are the ranks and what are the constituents of those companies which have come in and the signals that are given, right? It always look at the market condition and it deploys. So when I showed you that, chart where Deepak Nitrite was around 9%, doesn't mean that when a new client comes in that I will go ahead and buy Deepak Nitrite, right? So number one is that it will look at the market condition at that point. And we have seen typically in our live data, right, of around 3 years, usually the deployment happens anywhere between 20% to 55% on day one. The strategy will look and create a portfolio looking at the market condition and deploy it over a period of time. Usually the deployment happens anywhere between 3 weeks to 6 to 7 weeks, right? So depending upon the market cycle, there is no forced deployment and there is no manual intervention to the strategy, right? And it is also, so it doesn't shy away to sit on cash if it doesn't find the right signals or the stock to invest in from the investable universe. So I hope I have answered that question.
Getting it. So you're saying essentially that everybody's portfolio may not be the same, and depending upon the market situation levels, it will vary from one to another. Is that correct?
Absolutely. So if you look at some of our live portfolios and our clients, right, the constituents of their portfolio back in September 2019, and now if you look at September 21, the portfolios will be are different, right? So as long as it is the strategy has invested around 65 stocks, but one client guy will have only 20 to 25 stocks, right? So it is very different, and it is dependent upon when stock was entered, when the client was activated. So it depends on many parameters, and that only a system can do, right? A system can only have, or a computing power can only have and figure out how much cash the person is sitting on, what stocks it has, and everything at our end is driven by the system. So you're absolutely right. The constituents of stocks between client A and client B, if they are significantly away in time period, might be different.
So during the presentation, you also mentioned that this model portfolio also generates good amount of cash. So what are the circumstances in which it can generate significant amount of cash? Like you talked about COVID or 2008 Lehman Brothers crisis.
Right. So, that's a good point. What we do is that we have said that we'll not argue with the markets, right? And if some of our thresholds have been broken, and if the market is not conducive, it goes ahead and sits on cash. So what happened was during COVID, it went and sat on cash up to 65%. And over next 3 months, it started deploying. One more thing which I would like to highlight here is that before COVID hit, right, in December 19, we had almost 30% into financials. When it came to COVID, when COVID hit us, and when the strategy created cash, right, we had 0% in financials. So this strategy is all complete bottoms up. It will look at where the opportunity is, and then it started deploying into specialty chemicals. We started buying Deepak Nitrite, so this is how the strategy works. It is void of any sectors. and will not shy away to create cash when the market is not conducive, and it will not argue with the market. It will go ahead and sit in cash.
So Vikas, basically what happened was that, if many of your price thresholds are violated, right, the system will sense that the risk reward is not in your favor, right? And it also takes the volatility of the market, right? So if for a certain kind of company, if you are ending up too much volatility in the market, it is happy to sit out until the volatility compresses, and then it starts to invest back in the market. And what he made an interesting observation, and what we also found, was that typically what happens whenever there is a large drawdown in the market, a 20% plus kind of a correction, more often than not, leadership among sector changes. So the leadership of the previous bull market was private financials. And what happens, whether you like it or not, people's portfolios were loaded with financials.
Oh,
And
yes,
as you
more than
know,
35%.
yeah, and as you know, up until recently, even in fact now, right, the bank Nifty has underperformed the Nifty by a huge margin, right? But there were other sectors which really did very well: IT services, specialty chemicals, pharma, textiles, right? So it has no bias. It doesn't say कि अरे index में 35% है तो I have to keep some financial in my portfolio. And what happened was that many of these companies, banks had to show a loss because they made provisions. NPAs were very high, right? And therefore, until that smoothens out in the numbers, right, it will not allocate. So, but you didn't lose out. You actually did better by not owning financials during the last 12, 18 months. You actually did better owning some of the other sectors where the numbers really did very well. And, that is the reason why some of those indices are doing better than, better than the banking index, right? So there is no sectoral anchoring or bias that happens. And it will go where fundamental performance is there. So there has to be a combination of fundamental performance and the market recognizing that fundamental performance and rewarding companies, right? So when the two meet is when all the tick marks happen, and then it chooses the stocks.
Well, that's a great way of, riding through the growth journey. So the other question is, this is for Hiren. So, how does this model portfolio react to situations like now the current situation, which the global economy is going through, like geopolitical situations, where, or maybe the Fed hiking rates or interest rate going up in India back. So what is your view on that?
See, I think a lot of that is noise, right? The system cannot recognize that your market is correcting because of X, Y, or Z, right? But there are certain, but if there are certain stocks where the market is very intelligent, right? So if it corrects very high PE stocks, then it is telling you that probably the regime is changing, right? And therefore it will go to stocks where maybe the valuations are more reasonable, and it will not catch a falling knife, so to speak, in market language, right? So it does not bother too much about what is causing the disruption. It will take the disruption into account, right? It will, and that is why if you see, there are certain stocks that survive these kind of disruptions, and there are certain stocks that don't survive, or there are certain stocks which may have better survivability during a certain kind of headwind in the market, right? So for example, now it has recently taken more low beta stocks in the portfolio, like TCS, for example, or recently we got a capital goods company coming in like L&T into the portfolio. So it recognizes the trend change that is happening because of the volatility, right? And it will respond accordingly.
Next question is for Deven. Deven, you mentioned that you allow winners to grow and cut out your losers. But what's your exit strategy like? Don't you think sometimes you can go overweight on one particular sector or a particular stock?
Right. So see, like I said, this strategy is designed to be like how Nifty behaves. Right. It sticks with the winners. So you never know, and we have seen in the past, right? The winners always keep on surprising on the upside, and losers, when it starts doing down, it always keeps on surprising on the downside. So what we have done is the exit strategy is very clear. Risk mitigation is very clear, that it will start put a threshold that beyond this threshold, if the stock goes down, it will move out, right? Or if the stock is staying, like for example ITC of the world, right? If it has not done quite a bit, right? It is on a flat. So something like this, if a stock comes into our portfolio and is not performing and wasting a slot, right? Then, but a superior candidate is available, then we will go ahead and replace that stock, right? So there are two ways of how the stocks moves out. But on the upside, we have seen that, arguing with the market on the upside or a stock on the upside, we will, that was Nifty also does, right? The market cap of those companies, and they still stay in as part of the constituents, and they keep on growing. So we have emulated that regime, where on the upside we don't go ahead and say, because you never know what is the top point, right? For example, Tata Elxsi, 2 points to be made out here. During COVID, the stock was at around 500. Active fund manager would be very scared to buy it at 5,000. The strategy bought it at around 4,800 again, right, at us. Now from there it went to 5,000, 5,600, 6,000, 7,000. How do you know what is the top, right? So we have stayed with that position, right? So that is how this works. It stays with the winners and it starts culling out the losers.
See, Vikas, it's like this, right? As he said, I mean, like, for example, because private financials kept on performing, their weight in the Nifty kept going up, right? So it is not that somebody decided that it should be 35%. It organically became 35%. And now if there is a mean reversion that has to happen, which is other sectors have to take a slightly higher share, which means that those inherent constituents have to keep performing for their share to naturally go up. Right? So if Reliance is 14% and if Reliance doesn't perform tomorrow, then slowly Reliance's weight will keep coming down to 10% and then sub 10% in the index, right? So it is something like that. You don't disturb something which is in natural motion as long as it is backed by data, right? So if it continues to perform fundamentally, and if the price keeps going up, why disturb unless the price shows a very worrying behavior or the numbers start to tell you a different story?
Okay, next question is from Mr. Rajendra. So how to get and create a lot of good wealth when markets are so volatile at this point of time? It's basically, I think, more to do with should we enter right now or not?
See, at every point in the market, your risk reward in some stocks will always be great, right? And as we have shown, that to remove this bias of when should we enter, is it a top, is it a middle of a bull market, is it a bottom of a market, we have tested this strategy on various random dates. It could be the first date of the financial year, it could be the first date of the calendar year, it could be a top of a bull market, it could be the middle of a bull market, it could be the bear market. It doesn't really matter. The beauty, at least in this strategy, is that it doesn't really matter. It will look at the market situation. It will look at if there are any deserving candidates based on risk reward, and it will invest. And if it doesn't find candidates, as Deven said, we are happy to sit on some cash, right? So, so we don't really break too much of our head on what is going to happen today or tomorrow.
Sure. And the other thing is, there's this saying that you make a lot of money when the data is back tested. So you mentioned that 6 years have been have gone into, sort of doing your own research. So you had put in your own money. Is there a skin in the game that when you are doing the back testing that you put your own money and look at?
Yeah, it was not on paper. It was not on paper. We actually put real money behind it. And we ran the strategy with our own money. And only once we were convinced that we have now brought the strategy to production stage, did we start, with client monies. And that also you should understand, we have a 18-20 year track record, right? So we initially didn't even go to external investors. We just went to our existing investors who were invested in our active PMSs and asked them that, look, this is something that we have developed. This is something that we've tested. We believe in it. Why don't you start allocating some part of your portfolio to this strategy? And that's how this strategy has grown, right? And the beauty is that one is back testing. Now, when we started in September 19, we did not know COVID is going to happen. So in a way, there can't be a better reflection that this strategy has got stress tested in a very difficult time period, right? So from September, the markets went up, then the markets crashed, then again the markets revived. Now the markets are sideways. I mean, we have actually seen the strategy perform, right, over this period. And therefore, it's not just about paper trading. So even when we back tested it, we used our own money, we tested it out. And only once we were completely confident that we started to accept money from external investors.
All right. So before we conclude the session, last question from my end. So how many stocks one can expect when he is starting the strategy? Number one. And number two, after 2 years, 3 years down the line, as you said that you cut down the losers, then how many stocks can be there after 2 years or 3 years down the line?
Right. So I'll take that. Initially, when the portfolio is formed, typically there are around, depending upon the market cycle, right? There could be anywhere between 4 to 10 stocks that come in, right?
On
day one, that's day one. And over a period of time, when the deployment happens, usually we have seen that on an average from all our past this thing, the stock portfolio is anywhere between 20 to 25 stocks. And this will move, obviously, if the stock, moves out and if a superior stock comes in. So the number of scripts, we haven't put a limiter, but technically speaking, and if you go mathematically, if each is 3%, maximum stocks that we can hold is around 30, right? But we have seen in the past, the strategy usually picks up around 20 to 25 stocks for one particular client.
I got it. So with that, would like to conclude the session. I take this opportunity to thank Hiren for taking the time out from his busy schedule and joining in today and answering all the questions so patiently. And thank you, Deven, for presenting this case so beautifully. So thank you so much. Thanks, dear participant, for joining in today.
Thanks, Vikas. Thanks for giving the opportunity. Thanks, everybody.
Thank you.
Thanks, Vikas. Thanks, everyone.